All right. Well, welcome everybody. Today we're going to be talking about how to buy a home in a hot real estate market, and we'll talk even about how hot is the real estate market. Let me just get everything running correctly. All right. And so my name is Michael Devlin, by the way. There's a slide that has my information coming up a little bit here. What I'm going to do is I'm going to add Monica and there we go. So you guys know. So my name is Mike Devlin. I'm a real estate broker with eXp Realty, and we're going to start off by talking about home financing basics, and we're doing this seminar in cooperation with Cooperative. That would make sense, right? Cooperative Credit Union. We're cooperating with them, and we're going to talk a little bit about the loan process and how to get a good deal when you're buying a home in a market like we're in today. Doesn't that sound good? So Cooperative Center Federal Credit Union is partnered with Westcom Credit Union, and the Westcom is the loan origination part. That's where they get the loan products from, and they actually do most of the applications and things like that. If you are talking, if you could mute yourself, I would appreciate that. I may not have time to go through and find everybody, but if you could mute yourself, I would appreciate it. Westcom is the credit union that funds the different loans. They work with Cooperative Credit Union. You don't really need to worry about that. We're just sort of letting you know. The loan officers, Lindsay, who's on the call, will be one of the people you could reach out to. Her contact information is coming up. Carol and Rick are loan officers with Cooperative Credit Union, and those are the people you would reach out to. Would you like to, when you want to begin the process? Right, we'll be getting to the good stuff. All right, so let's just start with, should you buy a house? All right, many of you probably already have an idea of that because you're at a seminar on how to buy a house. But some of the reasons that people are motivated to buy a house, one is simply so that you own something, right? If you're a renter, you can't necessarily paint the place the way you want to. You can't do what you want because it's somebody else's house. That's a big reason. People would like to have the room. They want a backyard. They want to do what they want. There's also stable housing costs because most of the loans we're doing today are fixed rate loans. 30-year mortgages, fixed rate. You know what your mortgage payment is going to be, right? The amount that the property taxes, other things that might increase isn't that great. And if you're renting, even with rent control and all of that, your rent can still go up 10% a year. Under the current, and rent control laws, by the way, vary by city. Berkeley has different ones than Oakland. But still, the rent can go up significantly. It's also a leveraged investment. So if you invest, you can buy a property with 0% down. You can buy a property with 5% down. Excuse me, but you get the appreciation. Let me give you an example. Let's say that you were able to buy a $800,000 house. Now, we can't predict the future. Like, how much is that house going to go up every year? We're not 100% sure, because if we could predict the future, we would probably have something better to do than this, right? Because we'd be out predicting the future. But how much have properties increased per year over the last 10 years? It's about an average of 10% a year. But we don't know if properties are going to keep going up at 10% a year. Let's say that the average appreciation rate of your property is 5% a year, right? 5% a year. Now, in the last year, it went up over 20%, but 5% is relatively conservative. If you look at home appreciation in the United States since the 1970s, the average is 4% a year. But then we're in California and we're in the Bay Area, and our appreciation rates are higher than the rest of the country. So what does that mean? You buy an $800,000 house, it goes up 5% in 1 year. That would be a $40,000 increase in the value of the property. All of that $40,000 belongs to you as the homeowner as additional equity. And if you take the $40,000 and you divide that by 12 months, what it means is that your house is appreciating at a rate of $3,300 a month. And so one of the things to think about is, well, how much is my mortgage payment? Right? And sometimes when you throw in the tax savings and the appreciation, what you're going to find is that the house is making more money in terms of equity buildup than you're actually paying on your loan every month. $3,300 is what a $40,000 increase in value would amount to per month. So let's say 5 years go by. Now this actually understates it, but if it's going up $40,000 a year and it does that 5 years in a row, it means at the end of 5 years your house would be worth $200,000 more than it is today. It's actually more than that because the 5% sort of compound. So the first year it's worth $840, the next year it's 5% of $840. But let's just forget that to make this a conservative number. In 5 years, you would have $200,000 in equity built up. Now, that gives you a lot more options. You could buy a bigger house, you could buy a better house, you can move to another. You've got a down payment when you sell that property. And then the other question is, if you didn't buy a house, would you be able to save $200,000 in 5 years? I'm not sure I could do that, right? Scrimp and save and, no more Starbucks and Pete's, right? I'm making my own coffee, picking it up at, you understand, 5 years, $200,000, that's a lot to save. And so one of the advantages of being in real estate is as an investor, as a homeowner, right, which also makes you an investor, is that it's like a forced savings plan, and in 5 years you could have hundreds of thousands of dollars of equity that you don't have today. There's also tax advantages. In addition to a deduction on the property tax, there's also something called a capital gains personal residence exemption. I'll give you a quick idea of what that looks like. Let's say you bought a house for $500,000 and that property is worth $1 million today. That means you have $500,000 in profit, which is called a capital gain. If you're married and filing a joint return, you get a $500,000 exemption when you sell the property, which means you sell the property for $1 million, you make $500,000 in profit, but you also have a $500,000 exemption, which means you pay no capital gains tax. You understand? You made $500,000 from the sale of your property, you put the money in the bank, you can spend the money, but you don't have to pay taxes on the money. Where can you make $500,000 and not have to pay taxes? You have to be really rich, I think, to do that, or have a investment in real estate. So, I didn't know I was going to do that. All right, great. So in order to get started, you need the following documents. You're going to need your pay stubs. You're going to need your W-2s for 2 years. If you're self-employed, you're going to need your tax returns and bank statements for the last 2 months. Those are the documents that you would need to collect if you're interested in moving forward. And there's 4 keys to getting the loan. One of them is job stability. Right? Credit history and credit score, your cash and income qualifications. Those are the 4 components in getting a loan. So job stability means that you've been in the same or similar job for 2 years. Now that could involve different companies, right? If you move from one company to another company, but you're essentially doing the same thing, that still counts in the 2 years. Right? You could be self-employed. It can include part-time, and there could even be gaps as long as you have a good reason as to why you had the gap. Your credit history, obviously your credit score will have an effect on the loan amount. It has an effect on the terms. It could even have an effect on the interest rate. And the question is, do you have a habit of paying your bills on time? And do you have a lot of open credit lines? Do you owe money to other people, long-term debt? Do you have accounts that have been open for a long time? That's obviously sometimes a good thing because you've established credit over a long time. And if there is a public record search, does it show tax liens? Have you had a foreclosure? Are you in collection, bankruptcies, judgments? All of that affects your credit score, and your credit score affects your loan. Then you also need some cash. Now, many people, when they survey buyers and ask them how much do you need in order to buy a home for a down payment, a huge percentage of people say 20%. That's not necessarily so. There are loan programs that you can use that require no money down. There's special qualifications for them. Plus, there are programs for only 5% down. The rest of that money can be borrowed. However, you need to understand that there are other costs involved in addition to your down payment. And those are called closing costs. And depending upon a variety of factors, that could be 2 to 3% of the purchase price. And the bank would like to see, the lender would like to see that you have some money in reserves, and that would be enough money to make payments for 2 months at a minimum. And we call that PITI, P-I-T-I. And PITI stands for principal, interest, taxes, property taxes, and hazard insurance. By the way, sometimes that might include homeowner association dues and things like that, but you're going to need at least a couple of months of cash reserves. That looks fine. I didn't even know I was going to do that either. Closing costs. So part of the 2 to 3% that you're going to need, some of that's going to involve an appraisal. If you're going to get a loan, you're going to need an appraisal. It might involve a home inspection. In our market today, sometimes sellers have already gotten a property inspection and a termite inspection. They've done all that. And at which point you have the option of either accepting theirs or going and getting your own. And then there are title and escrow and recording fees. The Westcom has very low lender fees, but depending upon the county you're in, sometimes the buyer is going to have to pay escrow fees and title fees and recording fees, and that arrangement varies a little bit by county, but that's all within the 2 to 3% estimate that you're going to need in addition to your down payment in order to close. Qualifying income. So they like to see regular pay. Overtime, bonuses, and commissions, if it looks stable, if it looks consistent for 2 years, will include. You could have a part-time job and throw that money in as long as you've been doing it for 2 years. You can use retirement funds and Social Security and pension funds, disability income, and you can be self-employed, and it's even possible to get people to be a co-borrower, which means that they are going to sign the loan papers with you and be a partner in the purchase of the property. All of those are the kinds of income that would be considered in determining how much of a loan they're going to make. Now, related to that is something called the debt-to-income ratio. And what that means is that the lender is concerned that you don't have too much debt and that you are able to make the mortgage payments. Now notice the ratios are between 41 and 49%. Let's pick a middle number, 45, and I'll give you an example. Let's say that a family is earning $10,000 a month, and the debt-to-income ratio is 45%. What that means is that your maximum mortgage payment, including principal and interest and taxes and insurance and HOA dues, that maximum payment is $4,500. Now, if you've got other long-term debt, like car payments and things like that, they're going to add that in. In other words, $4,500 on a 45% ratio is the maximum amount that the lender is allowing you to have in order to get a loan. That would include your mortgage. It would include other long-term debts. If you don't have any long-term debts, then all of that could go to the mortgage. And so it could be your gross income if you don't have long-term debts, but it could be your net income if you have long-term debts. Now, the thing about that ratio, one of the things that sometimes borrowers get into is they only are looking at interest rate. And whereas the interest rate, of course, is an important factor in getting a loan, this ratio is also a very important factor. because you might find a lender that will have a lower interest rate, but they won't lend you as much money to buy the property. Right. So one of the advantages of working with a credit union like Cooperative is that they have better underwriting guidelines. And what that means is that if you're a member, they're going to be more helpful in helping you qualify for the loan. In other words, their rules are not as strict, and they will probably lend you more money based upon the same qualifying income that other lenders might. Mortgage insurance. There's private mortgage insurance, and then there's mutual mortgage insurance, which is FHA. And that, if you don't have 20% down, then you're going to have mortgage insurance. Now, the reason for this is the lenders know that if they have to foreclose, they're not going to get 100% at the foreclosure sale, because people don't bid, market value at foreclosure sale, and that they could lose 20% by just having to go through the foreclosure process. So if you've got 20% down or more, then they don't have to worry about that, and they don't charge mortgage insurance. If you have less than 20% down, then they have to worry about what happens if you can't pay and they have to foreclose, and so there's mortgage insurance. And conventional, after the property has gone up in value, you might now have 20% equity. You could have it removed. FHA, you have to refinance to get rid of it. Other services Cooperative has is paperless processing. It's been a while since we've been going into offices and handing people paper, but all of this can be done paperless. It's online. You upload things. And all of the processing, servicing, and underwriting is done in California, which means you can talk to people during normal business hours about what's happening with your loan. You should get pre-qualified, and we're going to add to that pre-approved. Later, we're going to talk about what pre-approval means and how you could leverage that into getting a better deal when you buy a house. But before you start looking, you ought to find out exactly how much you can afford. In our market, most sellers won't even look at an offer unless you're pre-approved. And there's Lindsay and her contact information, so you can either reach out to her or reach out to the other agents that we have in the handout, which I assume most of you have by now. Some of the animation, there we go. So now we're going to segue from financing basics. And by the way, if you've got questions, you can go ahead and put them in the chat or hang on to them at the end. We're going to go through all of the questions that you might have. And we're going to now talk about what are some of the strategies, what's going on in the market. And what I would like to do is to let Monica take over from this. And so she's going to explain the home buying process. And while you're doing that, we're going to make Monica the spotlight. All right, Monica?
All right. Thank you, Mike. So I have copy and paste a couple of times because I saw people coming in at different times. So that's the Hangouts for you. So you can download that and have it for you. That's very handy. So now we're going to talk about the home buying process and why you need an agent. So there's a lot of people behind the process of buying a house. You need an agent, and the agent has all these people behind her. You need a loan officer, and you have all these people behind that person, and then you have an escrow person, you have all these people behind her. So there's so many layers, and you need somebody really good to be able to hold your hand and help you through this process. So we're going to start with the initial consultation. You talk with your agent, you tell them what you want, what you don't want, all the neighbors, the neighborhoods, and the schools, and all your criteria. So after that, if you're not pre-approved, we'll help you to get pre-approved. Then we'll find your favorite properties based on the criteria. Then we're going to go and see homes. Now it's really nice because open houses are back in the market. We can go and see houses. But sometimes you get that property that you can get in only by appointment. And I'll make sure to make that appointment for you. Once you like that house, we can make an offer. So then there's this thing about called earnest money deposit, which is the hook. This is how you hook that property that you like. It's more or less 3% of the price. Then we have to do our due diligence, and we get to the contingencies. We have to make sure that inspections are done, the title is correct and clean. You can get a loan, all those things. Then we can remove contingencies from our contract. Then you're ready to sign loan documents. Once you sign the loan documents, you're ready to make the final payment, which is the difference between the earnest money deposit and whatever you decide to put as a down payment. 10%, 20%, you have to make the rest of the deposit by now. Then escrow will be able to help you with the closing and the recording of your new property. Now you have a new owner. The county needs to know that. We'll record all those documents with the county. And then you get the keys. Sometimes we get the keys the same day. Sometimes we have to wait a little bit for next day. All right. Thank you, Mike. So this is the question. Is it a good time to buy? Is it? I mean, the prices are crazy. There's so many offers. Is it a good time to buy? And the answer is yes. Why? Because the interest rates are low. And I'll show you another slides later on how low they are. The inventory is better. We have more inventory at this point, and we'll talk about the reasons. And the prices are going to keep going up. So this is a good time to buy. Thank you, Mike. So this is the comparison between July last year and July this year. So the new listings are up. The Contra Costa County, I'm assuming there are a lot of people in the Contra Costa County in this meeting, is 13% up. Active listings are down. Why? Because they're sell fast. They're gone. They put it there a couple of days, gone. And the median sales price are up. For Contra Costa is 20% up year over year to 850,000. We can move on. There you go. So this is a chart of from Freddie Mac that is showing the interest rate. You can see the interest rates are super low right now. That's why it's a really good time to buy. And this data is from last week. This chart over here shows you the 30-year fixed mortgage rate that has declined to 278. Good time to buy. Again, we can move on. All right, so this is the mortgage rate projection. So those rates are not going to stay there forever. They are projecting that the rates are going to go up. And this is the sources: Freddie Mac, Fannie Mae, Mortgage Bank Associations, and the National Association of Realtors. They all have these projections that the rate is moving up. All right, so we have more inventory now. We have seen that the market has shifted a little bit to the buyer's favored. It doesn't mean that this is a buyer's market just yet. This is still a seller's market, but it's moving to the buyer's favor because there's more inventory. And we'll talk a little more about that. This means that, that's okay, Michael. This means that instead of competing with 20 offers for a house, we are going to be competing with 8 offers for the same house. It's better. The odds are better. All right. So this one of the reasons why the inventory is rising is the end of forbearance. So 25% of borrowers have decided to list their house because they don't have the means to keep paying for the house. The government gave them a big break not to pay the mortgage, but that mortgage went to the back of the loan. They have to pay now. So there's more inventory because of this reason. And everybody's talking about a bubble. Like the bubble that happened in 2008 or 2009. The bubble that happened back then, it was because bad loans, right? Right now we have fixed rates and we don't have adjustable rates, loans as much as before. And home buyers now, they have higher credit scores and they have more income. Before, back then, as long as you had a pulse, they will give you $1 million, right? And they wouldn't check documents, or they wouldn't check that you have a job. They just take your word for it. So that's why this bubble created and this bubble burst. But this is not going to happen this time around. This is a very interesting chart. Okay, waiting to buy a home could cost you money. And please pay attention to this one, because this is my favorite slide of the whole thing, because this slide shows and explains everything about the interest rates, what is happening. Okay, let's pretend we're buying a house for $750,000 here in the Bay Area. We buy it this year. The rate is around 2.8. So the monthly mortgage payment will be around $3,000. Okay? Let's decide to wait and buy a house next year. Same house is going to be higher. We're talking about around $840,000 now. Same house. The interest rate is higher now. It's 3.4. The monthly payment will go up. Will go up around $800. And you would have lost the appreciation projection of 12%. People will say, let's wait 2 years. Okay, same house is going to be $885,000 now. The mortgage interest rate will go up to 3.8 more or less. And now you need $1,200 more per month to pay the same house, to buy the same house. So that's why it's so important to have somebody to help you and buy your house right now. It's better now than before, than later. Later is going to be more expensive. All right. So the home buying services, what we do is pretty much everything for you. We'll help you to understand what you're looking for, to help you to qualify. If you want something very specific in terms of schools or neighborhoods or shopping, we'll be able to target those neighborhoods for you. For example, I had a buyer that wanted to buy in a very specific neighborhood in Brentwood. Schools were very important for her, but shopping was very important for her. So dropping off the kids and going shopping was very important. So we were able to target these two neighborhoods in Brentwood, and we bought a beautiful, beautiful house for her, and she was extremely happy. So the home research that indicates all the houses that are available in the market, and we'll be able to show you. Sometimes the customer will come to me and say, oh, I saw this in Zillow, and I'll do my research, because we have a little more information as agents. We'll have more information, and I will say, yes, this house is good to go and see, or no, it's not good to see, or that's why it has been in the market for so long. We'll be able to get more information for you, and we'll be able to come up with a really nice list of houses to go and see. We'll be able to help you with making the offer. Having an agent that understands the market and how to make a good offer is essential in this market at this point. For example, right now I have a fixer-upper in Berkeley, a $1 million fixer-upper in Berkeley, and I got an offer, and they didn't send me the proof of funds. So I didn't know if the person had enough money to buy the house or not. So those are kind of things that an agent has to make sure that the offer is correct, is good, and you'll be able to get that house. We'll be able to negotiate that offer. Sometimes we have counter offers. So we'll be able to negotiate that in your behalf. Vendor coordination. This is a very interesting one. Sometimes you buy a house and you don't like the color of the house, or you don't like the tree that is in the middle of the backyard. So we'll be able to coordinate that to you. We have vendors that work with us, and we can always offer you help. We'll help you with the pre-closing and the closing paperwork. Check to make sure everybody is in communication and they're talking to each other and your transaction is moving along. And the post-closing, this is a very interesting one. It just happened to me. I sold a house. My buyer was very, very happy. Everybody got their money. Everybody got their keys. Everybody, it was done. I got a phone call from the buyer saying, I have 200 hangers in this closet. I want them out. So even though everything was done, I made sure that I call 1-800-JUNK and we remove all those hangers from there. So those kind of things will be able to help you throughout the process, from the beginning to the end and beyond. So give us a call. We'll have you all our information at the end of the presentation. Back to you, Mike.
All right. Cool. All right. So thank you, Monica. That was excellent. Monica has a lot of experience in Alameda, Contra Costa County area, as well as that just part of the Bay Area. So reach out to her if you're interested in getting started in the process. So what I'd like to talk a little bit about is how to get a good deal, right? Because, maybe there's multiple offers. It's a hot market. I mean, it's cooling a little bit, but it's still kind of warm. And so there's some strategies. One of the strategies is you might want to have a real estate agent help you. Now, surveys that have been done of buyers, and the question they ask the buyers is, how did you find the house you bought? And 52% of the time, the buyer said, well, I found it myself. I was on Zillow or Redfin or Realtor.com. I found it myself. But over a third of the time, the real estate agent found the home for them. Now, sometimes it's because we're better at finding things on the multiple listing service than you might be using Zillow. But we also have the ability of finding some properties that are not in the multiple listing service, which means they're not on Zillow and they're not on Redfin and they're not on Realtor.com. Now, new homes, some of those are on Zillow, but some aren't. There are some new home subdivisions that you're not going to find on those apps. We also are able to target sellers that are not on the market. In other words, if you said, I want to buy a house in Martinez and it needs to be this much square footage and I need these many bedrooms and this is my price range, we actually have the ability to identify who in Martinez owns a home and has owned it long enough that they're likely to be able to sell it that meets your criteria, and then we reach out to those sellers. Do you understand? There are some people out there that would like to sell their home, but they don't want to go through the whole process, right? They list it, and there's open houses, and they got to clean it up, but they would be willing to make an off-market deal. For sale by owners, FSBOs, right? For sale by owners, they're not in the multiple listing service. However, sometimes there are some bargains that when we can find them. And distressed properties would mean somebody that has a notice of default because they've been missing their mortgage payments. The distress might involve they are going to bankruptcy. It might involve they're getting divorced. And we can identify the people that are in those situations, and you can have an opportunity perhaps to buy one of their properties. So we can help you find the home. What about Zillow, right? What about Zillow? Well, they're not always there. Not all of them. And in fact, sometimes Zillow has a lot of properties that are no longer for sale. I have clients that are always texting me pictures of a Zillow listing, and it's not actually for sale. It's already been sold. It's been taken off the market. And Zillow isn't very quick at removing them. I mean, if you think about their motivation, if let's say you wanted to buy shoes, and there are two websites you could go to buy shoes. And one website said, we have 300 pairs of shoes, 300 different shoes that you could pick from. And the other website said, we have 400 pairs of shoes that you could pick from. The question is, which one would you go to? And probably the one with the bigger number. So Zillow is working on the same concept. they don't really have an incentive to remove properties that have already been sold because their for sale count looks higher than some of the other programs, and that's just, people like that, but then they're unhappy when they find out it didn't sell. There's also, you need to realize with Zillow, misleading advertising. Because if you're on Zillow and you see a house and it looks nice and there's a picture of somebody next to the house and it says, if you want more information, call this person. And you might be thinking logically, that must be the listing agent. They've got the inside track. I'm going to call them. That's not the listing agent. Those pictures next to Zillow listings are not listing agents. Those are real estate agents that have paid Zillow for advertising. They don't know any more about that property than anyone else. That just happened to be their turn when their ad came up. So I've had buyers say, well, I was just going to call the guy next to Zillow because I figured that was the listing agent and they might know the answers. They don't know the answers. That's not the listing agent. If you're thinking, how much should I offer for a house? Maybe Zillow is correct. Zillow admits that their estimate of the value of the house is within 5% of the real value a third of the time. And they're within 10% only about half of the time. You understand, over half of the time, they're off by more than 10%. Right? 2/3 of the time, they're off by more than 5%. You need real numbers to determine what the value is and what you should offer. The second thing, so the first of the 10 ways of getting a better deal is to have an agent help you find the homes, right? A second is to be pre-approved. Now, the slide that I went over talked about pre-qualification, but pre-approval is really what you want. What pre-approval means, first of all, many sellers won't even look at an offer unless you have a letter that says you're pre-approved. Secondly, even if they would look at your offer without pre-approval, it'll cost you more to buy the house without it. If I'm a seller and there are two offers, and they're both for $800,000, and one of them is from a pre-approved buyer, and the other one is from somebody not pre-approved, but they plan on getting pre-approved soon, which offer would I take if I were a seller? I'd go with the one that was already pre-approved. When would I go with the one that wasn't pre-approved? Well, they would have to offer me more money. And it's not like $5,000. I'm not going to risk it for $5,000. It may not, 10 isn't probably even enough. It could be 15, it could be 20. There may be no number. I recently had a case where the difference between the pre-approved solid buyer and the one about to be pre-approved was $80,000. And the seller said, take the other one. I don't care. I'm making more money than I ever thought I was going to make. I want a sure thing. You understand what the sellers want more than anything else is that once they're in escrow with you, that it not fall apart. And the two reasons why it would fall apart is, one, you can't get a loan, or two, there's some contingency inspections and repairs that can't be met, right? You need to be pre-approved. And by the way, if you've gone through the process far enough, we're able to make an offer without loan as a contingency. And by the way, that means that you can save money. It also depends on who the pre-approval is from. Recently, I've seen them, right, where we get multiple offers. And one of them is a pre-approval letter that somebody had downloaded from the internet. You can see, because of the header and footer, that it was printed from a website. It actually had a cartoon character on it. We were not impressed with that pre-approval letter. Now, another one, the second one, came from a real estate agent who was also doing loans. That does not impress us either if we represent the seller. And the reason is because if the real estate agent is also doing loans, there's sometimes a conflict of interest. And what the real estate agent will do is they'll kill the transaction if they can't do the loan too, whereas we don't want the buyer's agent to be the loan agent. We don't want that because the chances of it closing are a lot less. But let's say the third pre-approval comes from a credit union. Credit unions are trusted sources, right? They're nonprofits. You understand, a mortgage loan agent might lie in a letter. about whether or not you're really pre-approved. I know that seems hard to believe that a commissioned loan agent would lie, but they might lie in a letter and say you're pre-approved when you're not pre-approved, right? Especially if the loan agent is the buyer's agent in real estate as well. We think the chances that they're lying are actually pretty high. The credit union is not going to lie. They're going to, if they say you're pre-approved, you're pre-approved. So you understand, if you just are looking for who's got the lowest interest rate, and I don't care who they are, that might be an issue when it comes down to making an offer, because if we don't recognize the lender, if it's not a trusted source, we're less likely to trust that buyer, that borrower, and that pre-approval. Much less likely. You need to be pre-approved. You should act fast. If you see something that looks good, move on it. Now, many people take I'm going to wait till the weekend and then I'll go to open houses, and then when I find a nice one, then I'll make an offer. You're unlikely to get the best deal possible if you're doing that. And the reason is that people that are really focused on buying a home and they want to get a good deal, they're not waiting to the weekend to go look at it. Right? When something comes on the market that fits your criteria and Monica has already seen it and she calls you up and says, this looks like it, make time to go see it during the week. There's oftentimes a rush by Friday to get some of these properties under contract before the weekend and before open houses. You need to act fast. If you make an offer and you get a counter offer, don't wait too long if you like the house. Because the longer you wait, the more likely it is somebody else might come and make a better offer, and then you don't get it. You should have your own agent. Some people think that, well, if I deal with the listing agent, maybe I can get a better deal because, all the business is going through the one agent. Now, the problem with that theory is this would be like getting divorced and using the same attorney your spouse was using, on the logic that why pay for two lawyers? She's already got one. Why should I hire my own? What's wrong with that? I'll let her lawyer do all the paperwork. Can you understand? There's a downside to that, right? In that the listing agent is legally obligated to negotiate the highest possible price and the best terms for the seller. Whereas if you have your own agent, they're legally obligated to negotiate the best price and the best terms for you. Sprint was doing the survey of people that they were relocating across the United States. And what they were looking at is how much did the buyer pay, and what they were controlling for is, did the buyer have their own agent or did they use the listing agent? And what they found is that if they were using the listing agent, on average, they were paying 5% more for the property than if they had their own agent. And I've seen buyers say, well, if I use a listing agent, he's going to give me 0.5% back, right? I'm going to save money. No, you're not, right? Because you may be paying 5% more for the property. You're paying maybe more for the property. Who do you want to advise you? Who do you want to go through the contract? Do you want the person who represents the seller to do that? Or would you rather have somebody represent you? Small price differences. First of all, if you're getting an 80% loan, right? Let's say there's a wobble of $10,000, right? I have a different example here, but let's say the price is $10,000 more or less. If you pay $10,000 more for a house, that doesn't mean that you personally have to put in $10,000. If you have an 80% loan, it means the bank is putting in 8 out of the 10,000. If you have a 90% loan, they're putting in 9 out of the 10,000. You understand, your amount of increase in cash is based upon your loan ratio. Now, this example was an interest rate of 4%, which is a little bit high, but I didn't have time to change it. What is the difference in a monthly payment between an $850,000 loan and an $800,000 loan at 4% interest, which is pretty high? It's $239 a month, right? And you've just got a $50,000 more, you got a $50,000 greater loan, which means you bought a house that's even more than $50,000 than the other one. How much? $239 a month. Divide that by 30 days. And then compare it to your average Starbucks daily bill. You understand? That's what we're really talking about on a daily basis. So don't think that if it's a $50,000 difference, that's your $50,000. The bank is putting in more money, the lender is putting in more money than you are, and the difference when it comes down to a monthly payment isn't as great as you might think. You should base your offer on the value, not the list price. So sometimes people say, well, whatever the list price is, I'm going to offer less. Well, that could be a mistake because some sellers are pricing the house deliberately low so that people will bid it up. And if you just offer less, you're not going to buy the house. Some other homes are so overpriced that offering the list price or less, you're getting ripped off. So in order to really know how much to offer, there's two things you really need to look at. One is, what are the other comparable sales in the neighborhood? Don't just look at Zillow, right? Don't just look at Zillow, right? They're not accurate that much. And that will give you an idea of what the property is likely to appraise for. You also need to look at the disclosures, right? You either, if they have them already, you need to factor in, is there termite work? Are there problems with the electrical system? Is there stuff that needs to be done? So you need real comparables, and you need to have an idea of what needs to be fixed in order to come up with a price that can be accepted. Just lowballing and offering less may mean that you'll miss good deals, right? And you may not buy the house. You have to consider the condition of the property. Pending sales. This is an oftentimes over-missed component, and by the way, only works if you have your own agent. The listing agent isn't going to do this. But what we want to do is to find all of the properties that are in the vicinity of the one you're interested in buying that are already in contract and are going to close. And the reason we want to know is for two reasons. What's going on with them? One is it gives us an indication of what the market is like. How many offers did you get? Did you get more than the list price? Right? The other reason we want to know is that those sales, when they close, will become the comparables that your appraiser is going to use. So if we know that a property is about to close on a particular day, and we know what the price is, and we know it's a quarter mile away, and it's a similar property, we know that that will be one of the comparables the appraiser was using. Finding out what's going on with the pending sales gives you real market knowledge and gives you a better idea of how much you need to offer or how you should offer and what the appraisals are going to be in the future. Inspections. Some sellers, the smarter ones in my opinion, will get a property inspection, a termite inspection, a roof inspection, a pool inspection. If those inspections, they'll get them all. And they'll give them to you before you make an offer. Now, if the seller does that, what they want is that you read them first, and if it's okay, that you would make an offer without that contingency. We'll talk, a contingency is a if. A contingency is a only if. I'm willing to buy your house, but only if it appraises. I'm willing to buy your house, but only if the title is clear. I'm willing to buy your house only if the inspections don't show anything wrong, right? So if the seller has done all the inspections and it all looks good and you can accept them, you've saved some money because you don't have to order your own. You could remove that contingency, which will get you a better price. I'll explain that a little bit later. Now, if the seller doesn't have inspections, then we would have the offer contingent on you getting them. And if the seller does have inspections, what we're going to do is read them very carefully. And what we're looking for is there a call out to have an electrician look at the electrical panel, or a plumber to look at the plumbing, or a contractor to look at the foundation. And if there's anything like that, then we want to make sure we have a only if contingency for you that we can get those things inspected. But if they've got the inspections and they look clean and you can remove that contingency, you're going to save money. Terms. You either are competing on price or terms or both. Some sellers want a little bit of time from when escrow closes before they have to move out. And that's because they need the money. And then once they get the money, then they can do what they need to do. They can put down the deposit on the other property or transfer the money to another property or move to wherever they want to move. And so by calling, this is one of the things that we do, we would call the listing agent up and talk to them and find out what are those other terms that might interest the seller. Because if there's two offers and they're the same price, but the terms we offer are better than the other one, our offer is going to be accepted. And remove contingencies when you can. So the contingencies, the main group is the loan contingency. Now, if you've been pre-approved, right, you may be in a position where you don't need that loan contingency. Appraisal. Now, unless you've got extra cash sitting around, appraisal is a contingency you'll probably want to keep. And the reason is that the loan to value ratio is based upon appraisal, not selling price. I'll give you an example. Let's say you write an offer for $800,000, but it only appraises for $790,000. There's a $10,000 gap between what you offered and what it appraised for. Now, if you're getting an 80% loan, or 90% loan, if you're getting a 80 or 90% loan, those percentages are not based upon the price, but they're based upon the appraisal, right? So if you have an 80% loan, it's 80% of $790,000, not 80% of $800,000. You understand that $10,000 difference would have to be made up by somebody. Either the buyer would put in $10,000 more, or the seller would lower the price to match the appraisal, or you could split the difference. Title means, is there a preliminary title report? Is there any issues with the title? I throw homeowner associations in with the title because if it's in one, we need to read them carefully because sometimes there's scary stuff in homeowner association documents as to what you can and cannot do with the property, like maybe you can't rent it out in the future and things like that. Now, the more of these we can remove, the better our offer looks and the lower the price. Two offers come into the seller, both $800,000. One of them has all of the contingencies. The other one only has one or two contingencies. They're the same price. Which one will the seller take? They'll take the one with the fewer contingencies. When would they take the one with more contingencies? And the answer is they would have to offer more money, right? Because the more contingencies there are, the greater the likelihood is that the buyer will back out and not buy the property. Removing the contingencies as much as possible and being prepared will save you money when you make an offer because your offer will be stronger. Speaking of saving money, I like working with credit unions. And one of the reasons I like working with credit unions is, first of all, they're nonprofits, which is why their loan fees are oftentimes a lot less than other lenders. But the other thing I like about credit unions is that it's all about the members. Right, and if you're a member of a credit union, it's you that they care about, and they have better terms and better rates and better qualifying for their members. And in a partnership with Cooperative Credit Union, what we're willing to do is we're also going to give you a credit when you buy a house. So what that means is that if you buy a $800,000 house, we're going to give you a credit of 20% of whatever our commission would be on that property. That would, on average, be about $4,000. If you're selling an $800,000 house, we could talk about that, but you'd save money too with this program. And you can see as the price of the house goes up, the effect of that credit obviously goes up. And that money is money that you could use for closing costs. Remember all of those closing costs, the 2 to 3% that you're going to need. We're actually going to help you with that through this credit program that we have with Cooperative Credit Union. We're cooperating and giving you a credit with Cooperative Credit Union. For some reason that amuses me, but anyhow, you get the point. will help you save money and help you get into the house. That's what I look like, after a lot of photoshopping, and that's what Monica looks like all the time. So she doesn't need the photoshopping. And if you're interested in moving forward and you want to talk to the loan agents first, then we've given you their contact information. If you would like to talk about neighborhoods and buying a house, reach out to Monica. She knows that market really well. And at this point, go ahead.
I forgot to say, yo hablo español también y les puedo ayudar en su lengua. I speak Spanish and I can always help you understand the market and the transaction in Spanish as well.
Thank you very much. Whatever you said, I'm sure it was beautiful.
¿En español?
Yeah.
¿Tiene marketing?
Sí, tenemos mucho en español. En español hay mucho marketing. Le puedo explicar el círculo de la transacción. Claro que sí.
So everything in Spanish?
Todo en español. Es Rosa Ramírez.
Sí.
Me puede llamar y podemos hablar y le muestro todos los documentos en español. Claro que sí.
Whatever you
Thank
say.
you.
All right. Whatever you say.
We're selling you a house, Michael.
All right. So,
Spanish.
yeah, I'm sure you were. Sometimes I think you're talking about us, but that's okay. You could get away with it. I don't see any. Are there any questions out there? Any burning questions? Even smoldering? I see a chat. Let's see. I know Rosa put in her name, so that's not really a question. All right. It appears that we've done it all within the allotted time, which is, so Rosa is sharing her phone number, which I think is probably for Monica. Am I right?
Yes.
Am I right? As opposed to me.
Yeah, you're right.
Yeah.
I'll call you, Rosa.
All right. And in fact, we ought to talk, Rosa. I have another. We ought to talk. All right. If there aren't any more, would a copy of this presentation be available after? We've been pasting it in. I think we've been pasting it in. I'm going to paste it in one more time. And if you don't have it, you can, email it to it. Which cities do you specialize in? Shima Motoyama, what cities are you interested in, Shima? We cover the Bay Area. Monica does a lot of business in Alameda and Contra Costa County. I'm physically located right now in the South Bay Area. But there are agents that are on my team that are in Sacramento and Los Angeles and San Diego. So, all Bay Area, right? Well, Monica covers the whole Bay Area, right? That's all.
And Chima, we are a team. We're a big team, and we have a lot of experience. How many years do we have experience, Michael? Is it how many years? 40 years?
Why are you asking me that? So my real estate broker's license was issued in 1986. I was 9 years old, and my parents had to drive me to the exam. No, that's probably not true. But so we've been doing this for a long time in the Bay Area, and we know the market really well. East Bay, Peninsula, San Francisco, South Bay.
East Bay.
East Bay.
We'll help you.
Right.
We'll be able to help you.
And I've even got people in Sonoma, Marin, that we've got transactions going on in that area as well. All right? All right, cool. I think we're running out of questions. I think that's true. Lindsay, did you have anything you wanted to say before we're... Oh, let me answer one question. How can we compete with people who have millions in cash? The percentage of people that are buying all cash is not as high as you might think from reading the internet. The vast majority of purchases are not cash purchases. And one of the ways you can compete against all cash is be pre-approved, right? Because what all cash buyers want is a discount. So the cash buyer is going to be coming in lower in price, right? Because they're cash and they think that they ought to get a discount because they're cash. If your financing is solid, it isn't it isn't difficult to compete. There's a question about the pros and cons of condo versus single family home. All right. So for a while, up until 2020, condominiums were actually appreciating in the Bay Area faster than single family homes and townhomes. But then there was this virus. And so as a result of the shifts that occurred during the pandemic, the condominiums have not been appreciating as well as townhomes or single family homes, and that's because people generally wanted the extra space. Now, if you're thinking about getting started, you understand, just because a condo doesn't appreciate as much as a single family home doesn't mean it's not appreciating. And this is sometimes called a starter home, and this is a game that if you do not play it, you will not win. In other words, if you bought a condominium and then in 5 years had built up enough equity that you could sell it and roll that equity into something bigger, right, that makes more sense than trying to save all that money. But if you had a choice, a townhouse, which is a common interest development, they are bigger and generally more house-like and appreciate better. But, that's a condominium doesn't appreciate as much as single-family homes or townhomes.
Michael, I have something to add for the previous questions for Sonia, how you can compete with offers for cash, $1 million of cash. I had a seller that actually got 15 offers in her house, and we went with a less price. Why? Because we had the price and we had the terms. Remember the terms? And for her, it was very, very important to be able to stay in her house, rent back. Not only for 30 days or 60 days, but unlimited. So she got this deal. Not the highest offer, but it was an investor that allowed her to stay there. So it's always the terms and the money. So sometimes the terms are more valuable for the seller. That's why it's important to have a good agent to talk and understand the transaction and what is happening with that specific transaction.
The reason that sellers like cash buyers is because of the certainty of closing. If you're pre-approved by a real lender, like Cooperative Credit Union, if you're pre-approved for real, then the risk of you not being able to close because you don't have the money is much, much lower, right? And you can compete. Most of the sales do not involve all cash. I see Lindsay is visible again. Did you have any comments or?
The only thing I wanted to add was that if anyone, like Rosa, if you have questions about the financing or anything, one of our contacts from West Palm, Carol, she does also speak Spanish. So I want to throw that we do have Spanish speaking on the financing side as well.
All right. I'm not seeing any other questions. If you do have more questions, you can reach out to Monica, Lindsay, even me, but I'll probably refer you to Monica or Lindsay if you reach out to me. But reach out to us. The next step would be to arrange a time to talk on the phone or in person even about getting pre-approved and beginning the journey, beginning the process. All right. Well, I want to thank everybody for participating today. And always enjoyed working with Cooperative Credit Union, and reach out to us. Be safe out there, people. Right. Thank you.
Enjoy. Thank you.
Bye.
Everybody
Thank you, Mike. Thank you, ladies. Bye.
Thank you. Everybody say bye. All right. Thank you.